Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. The main activity here during the summer had been the fall below the significant neckline extension, currently at 657, of the small October 2020 to November 2020 head and shoulders top, which you can see highlighted on my daily chart in dark blue. This neckline has a fairly wide congestion area clustered around it, formed from late April to mid-July, from about 609 up to 679, including the declining gold-coloured long moving average, currently at 643, and below it now the declining mauve coloured medium moving average, currently at 613. It has been this congestion area that pressed down on top of the rallies throughout September, October, November, and even now in December. A few weeks ago I pointed out, and I quote, "We have also seen a pattern form over the last few weeks. The pattern I have in mind is an unusual one. It is one that immediately springs to my mind but looks in the wrong place, and that is to see the whole of the late May to end of July action as a double top, with a neckline at the same neckline extension of the small but influential October to November 2020 head and shoulders top." End of quote. This is actually called a cat's ears pattern. In essence, it's a double top in an overall previously downward moving market. It's not that rare, but enough that it took me a while to remember its name. The potential below for a cat's ears pattern is at target X2 in the 502 zone. However, before even looking down that far, it is worth looking at some interesting supports below, nearby, notably, and on a closing basis, the May 2023 low at 587 3/4, which is just below the March 2021 low at 592. Then the September low at 570, plus the December 2020 low at 566. And, again, only on a pure low market basis, the September low at 570. Last month we saw prices punch down through all these, getting down as far as just below the December 2020 low at 566. 2 weeks ago, but failing to make two consecutive closes below it before storming back up with a weekly key reversal up the same week. So 2 weeks ago we had a weekly key reversal up that pushed up through the declining medium moving average last week and used it as a support, reaching up to the slowly declining long moving average overhead, but halting as the long moving average capped the attempts higher. It is at this point that I feel obliged to introduce a mea culpa moment. 2 weeks ago I said the following, and I quote, "Now, recently I'd laid out an idea for a mid-September base possible horn bottom, even a triple bottom with October's action, though this is only feasible on the continuous daily charts. I gave it a primary target X up in the 640 area and a secondary harder to reach target X1 in the 650 area. I gave these a short window of time in which to be achieved, and unfortunately the market did not have an appetite for them or the pattern, so I'll retire them both after this commentary." End of quote. Well, if I'd only waited one more week, as you can easily see on the daily chart, the market achieved the primary target at 640 and just about reached the secondary target at 650 with a high last week of 649.5. It just goes to show that sometimes I should be a little bit more conservative and allow a little more time. That rise was the most for the moment, as prices since then have dropped down this week below the medium moving average and the July 2021 low at 609, and seemingly halted at the flatlining short medium moving average, currently at 601, that is highlighted in green on my daily chart. Now looking ahead and around, well, we obviously have the medium and long moving averages on top, but I've been more interested in seeing the reaction of the market last week to the March 2020 to date downtrend, currently at 652. That is just above the long moving average and the dark blue neckline as well. Back in July, even approaching this downtrend was enough to turn prices back. Last week I opined, and I quote, "I'm wondering if the same may happen this time. If not, will there be buy stops located a little above it?" End of quote. Well, so far the market has backed away but the congestion formed over September, November and around the short medium moving average is also interesting. The declining resistance and the fairly static supports crossover, I suspect. At some point they do crossover, I suspect, sometime in early February next year. And so we have some time to decide, but that time will be running out sooner than many may think. Chicago corn. The medium moving average, currently at 492, highlighted over my daily chart, has been an effective cap on this market since about March, especially back in June, then recently in October, November and now December. Even when it was penetrated, it still held down the market. The recent capping action in October resulted in a push down below the mid-September to late October lower bull channel line and effectively put an end to late July potential rounded bottom. It also changed the aspect and broke the follow-on higher to a larger pattern here, a May to September descending wedge pattern. In addition to the declining medium moving average, we also have the same old congestion band overhead between 490 to 498 that includes the 2021 low at 498, as well as the flatlining short medium moving average, currently 493, all pressing down on the market. At this point I'd like to introduce discussion on the latest pattern here, highlighted in bright red. It is the July to date downtrend, currently at 489, and the flat support also highlighted in bright red below since July, currently at 470. Together they make up a descending triangle possibility, a quite far advanced descending triangle possibility. So as I cautioned last week here, please be aware of false breaks on such an advanced pattern. The question now is whether the support below will hold or the resistances above. Now last week we seemed to have some pretty strong overhead resistances, but below, well, the lows formed over the summer around 473. If they didn't hold, well then we do have some congestion starting at 463, but it isn't that strong, and I would be concerned that the accumulated ammunition overhead from the descending wedge pattern, the bull channel, and now from the new descending triangle, they may just punch down through it all fairly easily. This was why last week I cautioned, and I quote, for a third week now it all depends on the 473 zone below. Well, that was last week and this is now, and with change we have seen the market open today in a narrow range above the bright red downtrend, but well within the 490 to 498 congestion area amongst the moving averages. Further up we have the breached February 2023 to date downtrend, currently at 502. I'm still concerned that this move up has been a false break, especially as the descending triangle reaches its apex in late January next year. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.